Hello everyone, I'm Christian Lundblad, a professor of finance at the Kenan-Flagler Business School and director of research at the Kenan Institute of Private Enterprise. And given our recent Trends in Entrepreneurship report at the Kenan Institute, I thought I would like to highlight one aspect of a particular interesting development over there, which pertains to the Chinese venture capital market. And so I think we should all appreciate the increasing role that VC has played in global economic growth over the last 10 years or so. In fact, global VC fund NAVs are now standing somewhere a little bit short of 500 billion US dollars, which is up from a fraction of that 10 to 15 years ago. And now, while VC has been a pretty long-standing component of US capital markets, I think the massive growth in China over the last 5 years is really rather staggering. So from early stage to late stage funding, the Chinese VC market really now rivals that in the United States, and deal sizes in particular are actually considerably larger on average. Now, while the most recent year, frankly, has exhibited a little bit of hiccups, and there's probably on the back end of a bubbly kind of period, I think it's fair to say that Chinese VC is going to play a very important role in Chinese economic growth going forward. So let's place VC in the context of kind of the Chinese maturation process. So China is unambiguously slowing. So the economy is slowing. I think everyone appreciates that. I think that's made even more complicated to some degree by particular concerns associated with the misallocation of resources. The government has a rather heavy hand where a lot of particularly scarce financial resources are channeled through a state-controlled banking system into state-owned firms, and some of those projects are frankly not the most compelling. That having been said, while I think that dynamic about sort of the burden of a misallocation of resources is important, really the slowdown has a lot more to do with a very natural maturation process in my assessment. The easy, highest value-add projects as a country is sort of beginning its development process, those have been picked. Those low-hanging fruit have been picked to some degree. And the harder projects are now the ones that are remaining. And those are the ones that drive productivity growth. Those are the ones that actually fundamentally move forward the technological frontier. And so in recognition of this kind of evolving story, these evolving opportunities, Chinese businesses are making a clear push towards higher value investments, often associated with intellectual research and development. And the government, too, there is squarely behind this kind of maturation process. It's communicated best, perhaps, in its Made in 2025 campaign. It's somewhat controversial, but it's an expression of Chinese desires to be or perhaps the major technological kind of advanced player in the years to come. And with this in mind, Chinese VC is a necessary ingredient for any meaningful improvements in the challenging areas of semiconductors, aerospace, energy, data analytics, and artificial intelligence. So what does this mean for asset allocators? I mean, from the perspective of investors with long-run foci, I would say, including foreign institutions like pension funds and university endowments and the like, I would say the most exciting parts of the Chinese story, I mean, they're increasingly technologically driven, number one. Number two, they're more structural in nature and hence maybe more sustainable, at least in probability. And three, they're largely domestic in nature. I mean, there's a considerably reduced reliance in China now already on the United States and Europe. I mean, that's happening almost automatically as this process is unfolding. So even if China is, sort of struggles additionally with this maturation process, there is nevertheless going to be significant growth opportunities associated with serving the inevitably expanding and domestic Chinese middle-class consumer. So you couple this observation with an appreciation for the truly remarkable penetration, really, of technology and data science in China. In fact, it's light years ahead of what we see in the United States and in Europe to some degrees. One must conclude that Chinese VC is here to stay. But there are some risks. So this narrative requires Chinese private capital market exposure. But there are at least two important risks that I can think of as particularly true for institutional investors and especially those who are foreign investors coming from outside. So number one, the US and China are, in my assessment, facing a significant recalibration of their bilateral relationship. And a downside risk is a sort of decoupling. It's a particular outcome that I'm feeling a greater degree of anxiety about these days, to be perfectly frank. I mean, there are some signs that the ongoing trade dispute may be calming, but I remain extremely skeptical that anything truly consequential has been established. What we've seen from the trade representatives, I would say, is at best a sort of a truce or a pause. I mean, there's exactly zero progress related to the deeper complaints about Chinese central government subsidies, about the allocation of resources in the way in which that they interfere with that, currency distortions, intellectual property rights, technological transfer, and so on. And so my hope, of course, is that things remain relatively calm. But let's be honest, I mean, the probability is certainly far from zero that additional disruption will manifest. And the key insight for this conversation is that one cannot separate goods trade issues from issues associated with financial flows and capital restrictions. So if we realize the worst case outcome on trade, then serious restrictions with respect to financial transactions are almost certainly going to transpire. And we've already, frankly, at this point, observed a sizable drop in cross-border foreign direct investment across the two countries. And so all global asset managers with significant Chinese exposure must establish a contingency plan. There has to be an acknowledgement of a state of the world where cross-border financial flows become seriously impeded. Second risk, even in the absence of any capital flow restrictions, China remains characterized by a host of institutional limitations. And these are particularly pertinent for foreign investors, I would say. Corruption, weak contract enforcement, poor information disclosure, a capricious unfriendliness to foreign investors, creeping expropriation risks. I mean, these are all too common risks that Chinese investments face. And I would say the concerns are particularly pronounced for foreign investors, and I would advise that these are considerably so for foreign VC investors, for whom the ability to rely on contracts in the face of significant conflicts of interest and weak property rights, this can be very problematic. So to be perfectly clear, I mean, the realized rates of returns on Chinese VC, they're really impressive. I mean, they stand in comparison with upper quartile VC returns that we observe in the United States. But risk benchmarking these kinds of highly speculative Chinese VC investments characterized by institutional weakness, this is notoriously difficult. Institutional vulnerabilities are hard to price, and there's little agreement among investors, other practitioners, investment banks, academics, consultants, and so on about how best to really articulate a kind of risk-adjusted return in a setting characterized in this way. So let's sum up. One, despite some of those limitations, every global investor has to think carefully about their China strategy. And I contend that Chinese private market exposure belongs in a global portfolio, and the Chinese VC market is very compelling. It's very proximate to the likely drivers of Chinese growth going forward. But careful risk management is required. Caveat emptor.